again. Okay, so this chapter is all about variable costing for management analysis. And we're actually going to do 3 videos or 3 problems. I'll probably have to do 2 videos, so I'll name this as part 1. So what we're going to look at on this problem, we've been given this information for the year ending December 31st. And what we want to do is we want to do a contribution margin analysis based on the sales for the year ending December 31st. And they've given us this information where we've had actual sales, our variable cost of goods sold, selling expenses, our total variable cost. Remember, contribution margin is the difference between your sales and your total variable cost. And we also have the number of units sold, the sales price, the variable cost, all that information for actual. We actually plan to do 8.2 million, and we actually plan on having variable cost of goods sold of 3,280,000, 902,000, and contribution margin of 4,018,000. But we planned on selling 41,000 units. And then we have our sale price, our variable cost, and that type of information. They also go through and they give us our differences. That's just taking your actual minus your planned. Okay, so all this information is given to you. So what they want to do is they want to do a contribution margin analysis to determine the effect of change in the sales. So for your sales quantity factor, what you're going to do here, you're going to take your actual, your 38,000, you're going to subtract off your 41,000 planned, and you're going to multiply that by the planned sale price. Okay, so if we do this actually in here, I'm going to take my 38,000 minus my 41,000 times my planned. Okay, so that puts us at a negative $600,000. Now when we look at unit price factor, what we need to look at is we need to look at the sales price, that 220 minus the $200 planned, and we need to times that by the actual 38,000 units. Okay, so let's go ahead and do that. So we have our 220, that was actual, minus what we planned, and then we take that times our actual. So that's 760,000. So what we can do is we can add these two together, and we have total effective change in sales is 160,000. So what this does, it just gives us an analysis of how when we looked at what we planned, we were under by 600,000, but what we actually did, we were 760,000, which makes sense because we plan on having a selling price of $200. We actually sold a selling price of 220. Okay, so that just kind of gives you a nice idea of how to do analysis on the sale quantity and unit price factor. So now let's look at, I'm going to hopefully get through this. If I don't, I'll add another video. So now on here, we need to prepare an absorption cost income statement and a variable cost income statement. And I've used a format that we do in the textbook. Here we manufactured 40,000 mini refrigerators. We sold 36,000. This information was given to us. We had the 6,480,000. We had direct material 3.2 million, direct labor 1,120,000, variable manufacturing 880,000, fixed 560,000. So that gave us 5,760,000. Our selling administrative, we had variable of 648 and fixed of 288,000, totaling 936. Now we need to look at, before we can complete our absorption cost income statement, our variable costing income statement, we need to get a price per unit. And I have two separate ones. I have price per unit and I have variable price per unit. Okay, when you're looking at the price per unit, and let me go ahead and put it in here so you can see this. We're going to take that 5,760,000 and we're going to divide it by how many we manufactured. Okay, so that gives us, we do the 5,760,000, we divide it by those 40,000 we made, and that gives us 144,000. Now there is a slight difference when we're doing the variable costing income statement. I need the cost per unit based on only variable. Okay, and let me go ahead and put it down here. So that's going to read where we're going to take our direct material, the 3,200,000, plus the 1,120,000. Remember, those are variable, plus our 880,000 variable manufacturing, and we'll divide that by the 40,000 units. Okay, so let's go ahead and do that. So we take the direct material, direct labor, variable manufacturing overhead, and we divide that by the number of units we manufactured. So that gives us 130. So depending on if we're looking at the total, because when we looked at the price per unit, that included fixed manufacturing overhead. Variable only included the variable. Okay, so let's see how this changes our absorption costing. So we come over here, well, sales are equal to that 6,480,000. Your cost of goods manufactured for the absorption is your manufacturing cost. To figure out the less inventory May 31st, this is where that 144,000 comes into. Because what we're going to do here, and let me go ahead and put it in here, we're going to take that 40,000 that we manufactured minus how many we sold times the $144. Okay, so let's go ahead and do that. We'll take our 40, because we're trying to figure out our ending inventory, divided by the 144,000. That's not right. Give me a... Okay, I did that wrong. What I meant to do, we're not dividing, we're timesing by the 144,000. So I do apologize that. We're timesing that. Okay, so our cost of goods sold, that is your 5,760,000 minus the 576,000. So we have 5,184,000. Our gross profit is your sales minus your cost of goods sold. Okay. Selling and administrative absorption, we're taking into account for everything. So that's the 936,000. So then our income from operations is 360,000 using the absorption costing system. Let's see how that changes when we use the variable costing system. So in our variable costing system, we're still bringing over our sales. Now notice that up here I said cost of goods sold. Here I'm going to say variable cost of goods sold. So this one is your 3.2 million plus your 1,120,000 plus your 880,000. We did not include that fixed. We're going to do fixed down below. Okay, so then that's where less inventory May 31st, we have to look at our variable price per unit. If we only did variable costs for the cost of goods manufactured, we have to do only variable price per unit. Okay, so that's going to be your 40,000 minus your 36,000 times your 130,000. Okay, so little bit difference in your ending inventory. We had 576 here. We have 520,000. So the difference is 4,680,000. That gives us a manufacturing margin of 1.8 million. So now we're going to look at our variable selling and administrative expenses. Remember up here we just came up with our gross profit and we added in our selling administrative expenses that included the variable and the fixed. Variable costing income statement. We're only going to bring over our variable for right now. Contribution margin, the difference between your sales and your variable cost. Okay, this is your manufacturing margin and your variable selling expenses. So your contribution margin is 1,152,000. Now I can bring over my fixed. So we have fixed, whoops, let me redo that. We have fixed of 560,000 and we have fixed of 288,000. Okay, let's go ahead and add those two together. And I got to put a line right there. So income from operations is your 1,150,000 minus your 848,000. Let's see if I can talk today. So we have income from operations 304,000. So depending on which costing system you use gives you a different income from operations. Okay, so I have a sales analysis to do. I'm going to do that on another video and I will see you guys shortly.